So in today's video, I am going to show you an important concept that will help increase your profitability because you will know how the market moves. So I will be discussing internal and external range liquidity. It is very important because market moves by seeking liquidity. And once liquidity has been sought out and market has tapped into it, it now reverses to look for another liquidity. If you understand this concept, you will see the tremendous results you are going to make in your trading journey. So what are external and internal range liquidity? I will first explain it for you, then I will show you how you can use it. Now, this is not a trading strategy, but it is a concept that is very important that when you combine it with your own trading strategy, you will see a lot of results. So when I am done doing this, I am going to show you two examples of trading strategies that you are going to combine with the concept of external and internal range liquidity, and you will see the kind of results that you are going to get. For you to understand this concept, you need to know what market structure is all about. Market moves and it has a pullback, it will move again and it will have a pullback, it will move and it will have a pullback. This movement that you are seeing is not just moving for moving sake. There is a reason why the market is pushing up and then it will pull back. But have you ever wondered why, if market is in an uptrend, it decides to reverse around here? Have you asked yourself why market reverses here? And then it pushes up. Once it goes past another previous high, you will see it will start looking for a way to retrace again. Once it reaches another level, it will now push up again. Like that, it continues. That is because the market is seeking for liquidity. Liquidity is simply people's stop losses. So most times you see that when anyone enters a trade at the top, they will set their stop loss just somewhere close to the top there if they have the intention of selling the market downwards. If some enter at the bottom, they will set their stop losses just below the bottom with the aim of the market pushing upwards. So whether you are in a buy or you are in a sell, people look for the previous highs and previous lows to set as their stop losses. And what attracts the market to move, what attracts price to move towards it are these stop losses. So when the market sees that there are a lot of stop losses here, it will push towards this direction to grab those stop losses. That is what is referred to as liquidity, people's money resting at previous lows and at previous highs. That is what the market is seeking. Market sometimes pushes with speed in such a way that market is moving, sometimes it will be going gradually, and you are following it. All of a sudden, you see that it pushes with speed that it may not give enough time for others to take an entry from this point to this level. So market goes very fast. It tries to retrace by coming downward, but it cannot, and it will now continue with its journey up. This large gap that is created, is because there are unfulfilled orders. So there will be order. People are making their orders here. They want to buy, but the market has moved with speed that they were not able to be filled. So what happens is that the market has to come back to fill these orders. So it will come back and try to give opportunity for those that did not enter by filling the orders, and then it will continue if it has the intention of a buy continuously. Now, before the market will reverse and come back to fulfill these orders that are inside here, it has to go up and clear the ones at the top. So we will have something like this. This is how it happens. You have a high created, market comes down and then pushes up to clear any amount of money here or any stop losses that are here. It will push up, and in the process of pushing up to clear the ones that are here, it creates gaps. It creates gaps because it will move with speed, or it may not fulfill some orders, and then those orders that are not fulfilled will create the gaps. These gaps that are created in the process are called imbalances, which means there's an imbalance between buyers and sellers. So the buy happens so quickly that there was no opportunity for other people to get in. So as a result, when the market goes to clear this, it comes back to fulfill these orders. When it comes back to fulfill the orders, it pushes up again to clear the ones at the top. And then it comes back to fulfill any orders that were not made here. And then it goes up again to clear the money here. Now, if the market has no intention of going further, it will now cause a change of character and begin to clear the money that are below. So it will come down. So it will clear the ones that are at these previous lows. And in the process of coming down to clear, it creates imbalances here. So because the imbalance is there, market has to go back to fill that imbalance and come back to clear the other one that is at this low. And at this low, it goes like that and creates imbalances in the process and goes back to fill the imbalances. That is the concept of external and internal liquidity. So we can now say that external liquidity refers to previous highs, swing highs, and swing lows, as we can see from this graph here. So we have market pushing up to this high. It comes back to grab the money that is at this low. Once that has been achieved, it goes up again to clear the one at this top. As you will see it, it comes back to clear the one at this low. That is how market moves. So anybody stop loss, whoever had intention of buying this market from this level, maybe they wanted buying here and they set their stop loss just below this point and they are aiming to go high to reach this particular level. The market will push a bit and comes back to grab their stop losses. Once that has been done, it goes up to clear the stop loss of anyone at the top. So someone may decide to sell around here and they will set their stop losses somewhere here, and their intention is to sell downwards to have higher reward. Market will push down a bit and goes back to clear the liquidity, their stop losses that are resting at the top here. Once that has been done, it now pushes down to grab anybody's stop loss that had intention of buying. That is just how the market keeps moving. And if I enlarge this graph for you, we are on the 4-hour time frame. So all the stop losses resting at the tops here and at these bottoms and at these bottoms, they are known as external liquidity. External liquidity. And in the process of forming these lows, you can see that market moves with speed at certain points, creating what are known as fair value gaps. Fair value gaps, which are If you don't know what fair value gaps are or how you can trade fair value gaps, there's a video I have made. It will appear at the top right hand corner right now. You can go and watch what fair value gaps are all about. So if market has created this particular high, it moves with speed to come and clear anyone that is here. You can see in the process, it creates these white gaps that are known as fair value gaps. You are seeing these are fair value gaps. So it creates these gaps and it has to come back to fill these gaps when it creates them. Because if these gaps that are happening, it means market sold so quickly that some people could not get in on the sell. So at some point, it has to come back and fill these gaps. You can see it. It has to fill the gaps. And these gaps are known as fair value gaps. Look at it here as well. Market move with speed here without giving opportunity for others to buy, and it created a fair value gap as a result of that. And you see it had to, after moving up, it had to come down to fill this fair value gap. The same thing happened here. You can see it. It moved with speed after clearing the external liquidity at these particular lows. Look at this low, look at this low, look at this low. It cleared every liquidity here with this wick and it moved with speed, creating a fair value gap here. And no matter how it goes, it has to come back to fill this fair value gap. So these fair value gaps that are created because market moves with speed in such a way that others could not be executed or filled, market has to come back. These fair value gaps are what are known as internal liquidity, because there are other people here that are waiting with their orders as well, with their money they want to buy at this particular level. So market is attracted to those people's orders. That is just how the market moves. Once this has been cleared, if it has the intention of pushing further, it will now what? Push further. Let me bring you. Look at it here. Market created this low and push up with speed, creating a fair value gap and got to this high. It came down to fill the fair value gap. As soon as the fair value gap is filled, it pushed down again to grab any liquidity, the external liquidity here. So it moves from the internal liquidity, it goes to the external liquidity, and now it has grabbed any external liquidity that was at this particular lows. As soon as it grabs that, it pushes up and goes to grab the one at this particular high. So it goes to this other external liquidity. As soon as it does that, it now what? Pushes down again, going to grab any other external liquidity that is here. It has grabbed the liquidity there. In the process, it created a fair value gap and it does as if it wanted pushing up. However, it came the second time to grab the external liquidity here and then push up with speed to fill the orders here in the internal liquidity. And as soon as it did that, it proceeded to grab the external liquidity that is here. You can see it. And remember, it has formed another internal liquidity here. So market has to keep pushing down to come back eventually into this internal liquidity that was created. You can see this is how the market moves. So market moves from internal liquidity to external liquidity. What you need to know is anytime you see a fair value gap, especially when you see it at the lower aspect of a swing low, you should know that market will come back to it. And in the process, when you begin to see price pushing towards this direction, Any sell that you see at the top here and you are selling the market, your target should be this internal liquidity. So if I see a sell opportunity as a result of this bearish engulfing and I want to take an entry, assuming you take an entry at the top and you set here as your stop loss, your target of course should be the filling of this internal liquidity, this fair value gap. After it is filled, market will want to grab any liquidity that is here. Once it grabs the liquidity, it will now form any fair value gap and move with speed and go to this other particular external liquidity. So after the grab of this liquidity, if you see any opportunity for a buy, your target will be to grab the next liquidity, that's the external one, at this particular level. And that is how it keeps going. Now let us play on and let me shrink the chart for you to see what happened. Market actually continued coming down until this liquidity here is grabbed. So the liquidity here, the external liquidity here is grabbed. And when it was grabbed, as soon as this is grabbed, market started retracing. You can see that the gap between these swing lows are becoming lower and lower, and it becomes lower and lower until it cannot form any other low again, and then you now have a change of character at this particular level. And at the area of the change of character, you can see the large gap created here. So your entry will be at this particular fair value gap. Once you enter at the fair value gap, I always enter at the middle of the fair value gap. So your stop loss will be just below that low. And your aim will be to clear this particular external liquidity that was formed. So your TP will be to target that high, to target this high for it to be cleared. And you can see the price continued like that until it will give you a 1-to-4 risk to reward ratio, a nice one. And price continues like that. That is the concept of external and internal liquidity. I believe with this you should have understood what it means. Now you can use your own strategy if you know that price moves in this format of moving from an internal range liquidity to an external range liquidity. When one is grabbed, it moves to the next one. Another one is grabbed, it moves to the next one. So let me use the concept of EMA crossover for you, the strategy of EMA crossover, so that you can see how these things play out in reality. So I am going to add my EMA crossover. So I will show it. It has been added to my graph already. When you add it, adjust your setting that the short one should be at the 50 EMA and the long one should be the 200 EMA. And when you are done, you click on OK. What we will be doing is to mark out our highs and our lows. So we can mark out this particular high that was created. This forms our external liquidity. And then you can also mark out any of the lows, such as this one, that form our external liquidity as well. Now you are not going to enter any EMA cross unless you have seen that a low has been cleared and you see an EMA cross, then you enter and join the trend. If a high has been cleared and you see an EMA cross, then you enter for a sell. That is just how simple it is. Okay, so from this particular level, you can see that this high, as price comes up to clear the liquidity that is here, we have an EMA cross occurring here. So this will be a signal for you, a genuine signal for you to enter for a short position. So you will enter your short position at the EMA cross, and your stop loss will just be above any recent high that was formed, and you will aim for 1 to 2. And make sure that as soon as price clears your 1 to 2, you'll be looking for another EMA crossover. So look at it here. Price cleared this low and started reducing the distance between the swing highs. They are reducing progressively. As soon as that happens, we have another EMA cross occurring here. So you will enter for a buy at this level. Why? Because we have seen that all the lows have been cleared. This one's cleared finally, as it's reducing until this particular one could not even clear this one. So we now know this EMA cross is genuine. You take your entry and you set your stop loss, just any recent low that you are seeing there, and you will aim to clear the next external liquidity. You see, I am using the EMA cross strategy, but I am also applying the external and internal range liquidity to it, and you can see how it gives you profits. Okay, now this particular high has been cleared, so we will look for any EMA cross. You can see we have a false signal here, and if we were to take our entry, we will have a stop loss hit. Why? Because there is no any strategy in the world that will give you 100% win rate. Okay, so taking losses is a must in Forex. I won't lie to you that it will continue to give you, because if you were targeting this external range liquidity, it will take you out in this particular one. But at least we have 1, 2 trades, one with 1 to 3 risks to reward, and the other with 1 to 2 risks to reward. So we have 5, and it has taken 1 out of the 5. So we still have profit of times 4 of what we are trading. So that is the concept of the external and internal range liquidity. Now this is in a live market for Bitcoin. So you see that if price has taken the liquidity here and it hit your stop loss, and you can begin to see that the distance between these swing highs and these swing highs are reducing until price cannot form another swing high higher than a previous one, and then it begins to break down. When you see your EMA crossover, you enter for a sell, and then that is when you can target this your external liquidity that is there. Yes, it is that strong. This is how to use the concept of internal and external range liquidity and apply it to your strategy in order to give you what more profits. If you have any question regarding this, just let me know in the comment section. Do have a wonderful day. Bye.